Hi there, folks. This is Mitch Firestone with Precision Trading Labs in New York City. I'm here to bring you trading levels in the major market indexes for the upcoming week of August 5th, 2024. I'll also do a brief market wrap up for the week that just concluded on August 2nd. So if we take a look here at the SPY, we're looking at a daily chart here. And so if we notice right here on in mid-July, a little more than 2.5 weeks ago, about 2.5 weeks ago, we had hit an all-time high here at about 565 here. And then ever since then, we kind of went through two kind of surges here, or I should say two kind of smackdowns here. One, we kind of pulled back here. There was a little recovery. Then there was another one. And then we had this recovery that occurred here on Wednesday. And then after that, there have been two major thumps down ever since then on Thursday and Friday. Okay, so right here we had this major push down here, and then yesterday on Friday there was this major gap, and then this another thump down here, and you could see there was a recovery of about halfway here, but this was obviously really ever since we've hit that all-time high, we're obviously in a little local downtrend here. Okay, so this week, ever since we hit this all-time high here, if you look at this blue dashed line here, you can see that we've actually lost about 4% or so ever since we hit that all-time high here. Oh, excuse me, ever since we hit this local high during this week. And if we go back to the all-time high, you can see we've actually the market's been paired by about 6%. Okay, about 5.9% there, and in fact, at its low point, it was about 6.5%. So that's what's gone on with the SPY. Okay, if we compare that now to the triple Qs, which of course is the ETF of the Nasdaq, and this has actually gotten a lot of press this week because we basically have seen more or less similar price action. But if we look at simply the numbers here, right here, this is where we had that thump down Thursday and Friday, and so you could see, again, there's about 5.5% that's come off the market ever since we had hit that high on Thursday. But if we actually go back to the all-time high and we go there, you'll notice right here we've actually lost about 10.5%, and at its worst, we were down about 11.5%. Well, in terms of terminology, that's an official correction phase. And so if you looked at Bloomberg or CNBC, or if you read the Wall Street Journal, you're going to probably see that all this weekend talk about the fact that we are now, at least on in the NASDAQ, an official correction phase. So that's kind of noteworthy. So I figured I would point that out here. All right, so let's take a look now, though, at some potential trading levels, and we'll go back to the Qs in a second here. But let's go back here to the SPY. Before I do that, though, the usual disclaimer: Precision Trading Labs. We are neither money managers nor financial advisors. Nothing that I'm about to present here is investment advice, and everything here is for information and educational purposes only. All right, so taking a look at the SPY here in the daily chart, if we look over here at this region right here at the very beginning of June, if you notice, price came up here, and again, this is the daily chart of the SPY. Notice price came up here and then consolidated here for a couple of days, and then notice that very, very bullish candle that emerged from there. If we look at this region, if we kind of zoom in on this region right here, if we think about it, the shares that were acquired by buyers, we can think of that as the demand for shares that's within this region here. Okay, so price closed there, it closed there, it closed there. Obviously, we can see that's all in a relatively tight range. So within this relatively tight range for that 2+ days, basically people were willing to buy at within a relatively narrow range, and we could think of that as the demand for shares. Okay, but then once price explodes out of there with that very bullish candle, no one's willing to sell in there anymore. Okay, and so if we think of obviously people that were we're buying shares here. Somebody, of course, had to be selling them. Okay, and so if we think of the shares that are offered up by sellers, we can think of that as the supply of shares. Okay, and so within this region right here, supply and demand are in balance. Okay, within this relatively narrow range, or let's say call it 525 to 529, that 4-point range. Okay, within that range, supply and demand are in balance. And then right here, all of a sudden there is an exhaustion of sellers. No one's willing to sell in there anymore. Okay, and so when that exhaustion of sellers occurs, okay, what's left in its wake is no longer a balance between supply and demand. There is no longer any supply in here. There's only demand. Consequently, we refer to this region, once prices exploded out of this, we refer to this as a demand zone. Okay, and that is the foundation for us in terms of looking for bullish trades. When we find properly qualified and analyzed demand zones that meet various criteria, when price returns to that region, we're expecting that there is either, we can think of it as residual bullish price pressure or upward price pressure that's waiting to be tapped. And so when price returns to this region, quite often we will get a bounce out of that, and that's where we would express a bullish trade. Okay, and if you notice right here, during that thump down, we had that thump, the gap, and then that the gap here, and then of course it opened here and it went all the way down there, and then it rebounded. Well, the reason that that rebounded here is because we had a demand zone that was sitting right there. And so that is the foundation for our trades. Now, we didn't actually get into a trade here on Friday because this was a very, very bearish move down here, and we didn't want to just take it on faith that it was going to bounce from there, plus the fact we were going into the weekend. And so we figured we would kind of let cooler heads prevail and let people kind of think about, let the market kind of digest the thump down, and the correction move on the Qs. Let the market kind of digest that over the weekend. And then potentially on Monday, if in the pre-market we see that there is some bubbling of a recovery, then this would be a place where we could express a bullish trade. So when we say expressing a bullish trade, how do we do that? Well, obviously the most straightforward thing, of course, would be to buy the SPY here at 529 and change. Okay, but other ways one could express a bullish trade would be to buy a call. Okay, and of course, because the calls are, and of course you could buy a call at the money, in the money, out of the money. Everyone's strategy is going to be different. We certainly have our perspective here of how we do that, but one could buy a call nonetheless. The other thing one could do is, because this is a very expensive share, it's, in the territory of, $550. The options are also very expensive. And so rather than perhaps just buying a call, one could reduce the premium by buying a call at a lower strike, and then and then selling one above at a higher strike. That's referred to as a bull call vertical debit spread, and that reduces your premium. And of course, it also makes it a gentler, more forgiving trade, because at that point it's gentler because it's running a lower delta, because you bought one call and you sold another. And then also the effective time decay is muted because of the fact that you bought a call where you have obviously negative theta for time decay, but then the one that you sold obviously has the reverse effect. And so this makes it a gentler trade and a more forgiving trade. Okay, but having said that, it's also a less responsive trade, but that's the trade-off. So one could buy a call or do a bull call vertical debit spread. And then the last thing is, if somebody would likes to collect premium, one could act on this demand zone here by expressing the trade in terms of selling premium. And so one could execute a bull put vertical credit spread. Okay, and that would entail selling a put at a higher strike and then buying a put at a lower strike. So you're not just sitting there selling premium with a naked put, but then you're controlling and managing your risk by buying a put beneath. And those are all ways one could express a bullish trade out of this demand zone here on the SPY. Okay, and in fact, that's exactly what a number of our subscribers did here with this supply zone here. Okay, so this is the same narrative of what I told you here, except on its head. Okay, notice price came up, rallied there, consolidated there, and then notice that very large gap and that very bearish move down, and then another bearish candle there. Okay, this is an exhaustion of buyers. Okay, where within here, the supply and demand were in balance. Okay, and then right here, all of a sudden, when we had this exhaustion of buyers, no one is now willing to buy here anymore. And so what is left in its wake here is supply, and hence we call this a supply zone. So this is a demand zone down here. That's a supply zone up here. And then if you notice, then when price came up here, and some people got into this on Wednesday when price reached that high and it kind of kissed the front of that level, and some people got into this on Thursday, but people expressed a bearish trade out of that zone here. Okay, and in terms of how we do that, it's exactly the same narrative here, again on its head. So one could short the SPY here, one could buy a put. Okay, one could do a put of a vertical spread, a vertical debit spread with the put by buying one put at a higher strike and selling one at the lower strike. Okay, and then of course one could also sell credit, collect credit by doing a bear call vertical credit spread. Okay, and that entails selling a call above more often out of the money. It's almost like doing a covered call, but instead of having the stock as your covering you, you have that higher strike call that you bought, and then at that point you're not selling the most dangerous of all instruments, which is the naked call. Okay, and so that's how you control and cover yourself that way. Okay, so in terms of distances here, this is where we closed right here. So this is where where a number of our where a number of our subscribers made a nice bit of money here. So this is now a tested supply zone. We generally prefer fresh zones, okay, because now prices come back here once, and so that has chewed up some of the supply here. So we don't necessarily, but we don't know that this is going to work again, but we'll keep an eye on this. So that's about 4% above here, and then similarly down here. This has only really kissed the level and then bounced off of here. So again, we're going to wait to see if price kind of pushes back into here and it seems to stabilize. We might just take a bullish trade out of here through generally one of these methods here. So that's the story with supply. That's the introduction to kind of supply and demand here, and then that's the story with the SPY. Okay, and if one was going to be looking for a fresh supply zone, then that's obviously back pretty much where we had hit that all-time high here, and so that's about 5.5% above here. So that's the story with the SPY. If we go back to the Qs now, so here's where we are now. We're seeing obviously similar price action. It's just the fact that the distances involved are what pushed this, of course, into the correction phase here. And so right here, when price rallied up here, notice that this is the origin of that move here. And if we actually converted this thing down here to a 2-hour chart, we would then see a clear consolidation and then that very bullish candle that kind of rockets out of there. And so this would be a demand zone from which we would express a bullish trade. And so on the spot on the Qs, excuse me, that's sitting at around 436. Okay, so in terms of where we are now, here's where we closed the other day. So if we get a further push down, okay, that's about 2.5% down from where we are. So that's where we would be looking potentially at a trade there. And then below that, there is another 2-hour demand zone that's right here. And so we'll obviously keep an eye on it and see if we do get a pullback here, how much energy, how violent is the push down. If it's relatively gentle, then I think we can perhaps consider taking a trade up here. On the other hand, if this comes to slamming into this, we would either wait to see price bounce out of here and then take the trade as it's bouncing out, or we would just wait for it to pull back a little further. Okay, so that's the story with the Qs on the demand side here, and then on the supply side. Okay, here is where we have a supply zone above here. And of course, we would need a recovery for that, but that's sitting, that's pretty much sitting at a fair distance away, about 6% up here. In terms of how these trades are structured here, if we look at this supply zone here, though, we can see this would be where our entry would be at the front door of that zone. And then what we would do is we would place our stop a bit behind the back line there. Okay, and a lot of times we'll use the daily average true range, and we'll use a percentage of that to kind of help guide us in terms of how much wiggle room we give in the trade beyond the zone. Okay, but that defines our one level of risk right there between our entry and our stop. And so each of these lines are equidistant in the same manner that these are. So if we got down to here after it pushed up here, that would be a 1-to-1 trade. That would represent a 2-to-1 trade at 472. And if we got down to 467 and change, that would be a 3-to-1 trade. Okay, so again, that's one R, 1 unit of risk here. And so that would be a +1 R trade, a 2 R trade, a +3 R trade. And of course, I'm talking in terms of the stock. Obviously, the analysis would be a little different if we were in an options trade, but in terms of the stock, that's the risk reward proposition on that. Also, a little side comment here. You'll see up here, I have this little comment here. The Qs are a relatively expensive share. Okay, it's around $450. Obviously, at its peak it was around 500. But the comment that I wanted to make here is, if you take a look at the XLK sector ETF, that's the tech ETF. Well, if you take a look at that and you line it up and you put it next to the ones with the Qs, you're going to see the charts look somewhat alike. And the share price on the XLK is about half that of the Qs. And so a lot of our subscribers, and then myself included, a lot of times we'll end up trading the XLK versus the Qs, because it just kind of gives us a little more flexibility in terms of the trade, particularly in using options. But I just wanted to point that out. So if for those of you who don't know that, take a look at the Qs and then take a look at the XLK. And I kind of use the expression that the chart rhymes. The chart's not identical by any stretch, but the charts do rhyme. All right. So that's the story with the Qs. Let's take a look at the IWM, which of course is the ETF of the Russell 2000. And so right here, obviously, there's that huge thump down that occurred in the latter part of last week. Earlier this week, though, a number of our subscribers, they did have a successful trade on the bearish side. Okay, if we go back now, unlike the S&P and the Qs, right here, if you notice, we got these two little blue crosses up here, and I'll just highlight this for a second here. Those little blue crosses signify the 52-week high. So in the case of the Qs and the SPY, the 52-week high was also the all-time high. That's not the case with the Russell 2000. Okay, this was a 52-week high here, but it was not an all-time high. And if we go back in time, we're going to see about 2.5 years ago, about 30 or 33 months ago, something like that, there was this region right there. Okay, and so that's the region where we had seen that prior high. That was a local high, and then of course you can see, and I believe that was actually the all-time high right there. So we're obviously a ways away from that. So I just wanted to point that's not an all-time high. But what happened was this supply zone right here. This is where a number of our clients, actually a number of our subscribers, actually expressed a bearish trade. Okay, and so if we now go flash forward, okay, that was again supply and demand were in balance. Then it went out of balance here. All that was left in its wake was potential downward price pressure that we're waiting to tap. And so then when price returned here, okay, that was where a number of people bought puts. And then we actually have a couple of our subscribers who like to collect premium. And so in fact, they did what I described earlier. They did a bear call vertical credit spread. And so they collected premium. So for them, and they sold them out, I think, with about 2 weeks or so to go till expiration. So they're benefiting obviously from the huge loss that occurred here, and then of course they're looking to capitalize on the time decay, um, running under the obviously the hope or the assumption that price is not going to necessarily drive all the way back here again. We're probably going to create some kind of base here, and price is going to consolidate and waste a bunch of time, and so that's what's going to aid that credit spread. All right. So, but here's where we are now. So right up here, right in here, we're going to be watching to see if we get a further pullback here. But right there, this is actually an area where price rallied up here. Even though it's a red candle, if you think about it, price gap there, okay, rallied all the way up, it consolidated there. And then notice then there's a thump down, it consolidates and then turns there. So right there's your turn in price there. And so right there, this is actually a demand zone right here. And so again, we had this thump down. So we're going to wait to see how and if and when price pulls back there. Here's where we will express a bullish trade. And in terms of, again, just showing you how we would map that out, again, one could buy a call, buy the stock, sell a bull put vertical the credit spread, and then again, here's how you map out the potential risk and reward here. So that's about 2250 there. Okay, and then we put our stop a bit behind the back line there, and so right here, there's your 1R of risk here, and so that would be a plus 1R trade, a 2R trade, a 3R trade. Okay, and that's how we would map that out. And the last thing we'll do is we will conclude by taking a look at the bonds. We're looking at the TLT ETF here. The TLT is actually the ETF of the longer duration bonds. So that those are the ones that are 20 years in duration and beyond. So it doesn't include the 10-year note. Having said that, obviously generally the bond, charts are obviously look very much alike. To use that term before, as I said earlier, they rhyme. But this is the TLT, so these are the 20-year and beyond, 20 and 30-year notes there. So right here, we actually have the inverse relationship with the market came roaring back today. Excuse me, at the end of the week, as equities got smacked down. Obviously, the bonds recovered, had a robust bullish move here, and that was a combination of that inverse relationship as well as the FOMC policy announcement this week and comments from the Fed. So basically, that kind of drove yields down, drove prices up. Okay, so there's the TLT there. So there's really not any kind of clean zone here. If I actually looked at this in the 2-hour chart, there might be there's probably a trading level also in here. Okay, but this is our daily demand zone. So that's obviously a long way down here. So what you would really need to do is potentially, if you saw a robust market recovery, you might just see this kind of collapse a bit. So we'll keep an eye on that. And then above here, in terms of supply, right here we had this is actually what I think of here. You might look at that and go, well, there's a supply zone right there. There's a rally at base and a drop there. And so when price comes back there, that might be a place to express a bearish trade. Maybe so, but having said that, this is no longer fresh supply. This is tested supply, because right here we had this drop formation. Okay, there's the consolidation. There's your exhaustion of buyers. And so now when price came back here again, there's your first test. And in fact, it actually violated the zone a bit. And so depending on, you might have actually gotten stopped out on this trade. But if not, if you gave it enough wiggle room, then you actually had a successful trade out of there. But then when price returns here, because price has already drilled in here once, I might not necessarily be racing to short out of it again. So if I was going to do that, I would probably look at that on a confirmation basis. And what I would actually do is wait for price to drill into the zone and then wait for it to then kind of show signs in a lower time frame that it's reversing, and then take it as it comes out of there. So in other words, price would come up like that, and then what we would be looking to do is then catch it as it starts to come out like that, and then our trade would look kind of like this. And you would take a trade perhaps just a bit below that, the bit below the zone of that, the line of that zone. So that's how I might structure the TLT. So at any rate, that's what I got. This is Mitch Firestone with Precision Trading Labs. Thank you for the privilege of your time, and I will see you next time.